How to build a multi-million dollar property portfolio and change you and your family's future. In today's episode, we are going to be breaking down and going through some of the crucial things that you want to implement to be able to not get stuck on one property and really build a multi-million dollar property portfolio. My name is Casey Taylor. I'm the host of the Tailored Property Wealth Podcast. Welcome back to another episode, and we're going to get straight into this one today. Now, the first thing that you really want to look at and adopt within your portfolio, especially in the early days of building that property portfolio, is using lender's mortgage insurance. Don't be afraid to use lender's mortgage insurance because it can, one, mean you can get into the marketplace sooner and really start to build that wealth sooner. I personally, for my first couple of properties, paid lender's mortgage insurance. On my second property, I paid $19,000 lender's mortgage insurance. Because of that, it was capitalized on the loan. However, in the next 12 months, that property performed and grew in value by $130,000. Now, the purchase price on that property was $429,000. So there was a massive amount of growth in that property. And yes, it costed me $19,000. However, what I was able to then achieve in a 12-month period allowed me to leverage and go into another property sooner. So it's really powerful to build wealth. Stop just focusing on the cost. Start focusing on what that cost can mean to build wealth. Now, if a property or a market increases 10, 15% in a 12-month period, and you could have got in and paid lender's mortgage insurance, it's going to be far lower than the capital appreciation and having to go and borrow 80 or 90% of that increased value. The second thing is don't go out and chase just the lowest rate in the marketplace. I see so many investors out there making this mistake. They think that they can achieve the lowest rate in the marketplace, but the reality is they might not be the lowest risk. Sometimes it means getting a rate that's not most competitive in the marketplace, or sometimes it means going out and getting a very high rate in the marketplace with a second, a third tier lender. But in some instances, you might not be able to purchase and borrow a property, but the second and third tier lender provide that solution to be able to get into another property. And as we talked about with lender's mortgage insurance, if you can get in sooner, you get that capital growth, you can then use leverage to go into another property. And that brings us into the third point, which is super crucial. You want to leverage your equity. You want to put your equity to work. Everyone's so focused on paying down their owner-occupied debt. However, if they put that equity in their owner-occupied property to work and build a larger wealth base and use that leverage to their advantage, it's going to be far more advantageous long-term for you. You don't want to just rely on the pension into retirement and have your owner-occupied property as the largest asset you own. Put that equity to work, leverage it when you can. And sometimes it's back to point one. You might go up to 90% of the value of the property, but it allows you to get into another property, or it might allow you to get into two properties. Point number 4, ensure you are surrounded with a team of specialists. This is so crucial throughout that process. You are leveraging everyone's knowledge and experience in their chosen field, which makes you as an investor far more sophisticated and far more educated, even if you don't typically have that knowledge. So you want to surround yourself with a quality buyer's agent, a quality investment savvy mortgage broker who looks long-term, who's really about wealth creation. You want to work with a conveyancer who's very specialized in their individual state, or a lawyer. You also want to make sure you have a quality property manager in place. I know firsthand, based on some experiences in my personal portfolio recently, how important quality property managers are. And you always want to be looking to leverage that quality property manager with expertise in their field. The next one, and this is when you're purchasing that property. You want to purchase under market value always as you go into a deal. I look at under market value in a number of ways. The first one being under market value compared to comparable properties. So you want to get 20 or 30K on the way in under some of the comparable properties in the area, because that gives you a boost from day one. And then under market value for location. Some marketplaces haven't performed strongly over the last 5 years, for example. And that means that they're very undervalued as a location and there's going to be strong performance. So if you can couple the two with under market value based on the comparable, but under market value based on location, and that it's going to perform strongly in the next 5 years, that is going to propel you forward, getting in that area prime for growth. You purchase well, and it means you can come back, leverage equity, and go into another deal sooner. Number 6, which leads from number 5 a little bit, data and research. You want to put a massive amount of time into the area that you're focusing on, making sure it has the fundamentals for growth. It's not simply looking online at realestate.com and domain, finding a property that looks good, but yet you purchase in a shit location, in a shit quality pocket of that suburb. The data and research is so crucial. You want to be looking at your income levels in an area, your demographics in an area. You want to understand the metrics that influence supply and demand, because it all comes back to supply and demand and what people can afford in an area. There's so many different things you must focus on to get the location right, but to then get the property right in that suburb, in that local government area. This is a short one today. I hope this has been valuable. If you can simply follow some of these fundamentals and these metrics, it's going to stop you from going to 1 to 2 properties and really build a multi-million-dollar property portfolio, really build generational wealth for yourself and your family. These principles are simple, but if you can implement and follow these long term, it's going to set you up for success. Any questions, you can reach out to us in the show notes. We can discuss if potentially there is an opportunity to help you with your property goals if you're looking to get into property investing and making a sound investment that's going to perform long term. Thanks for listening, and we'll see you on the next episode.